Topic introduces the statistical foundations required for analyzing investment data, measuring risk, and evaluating portfolio behavior within alternative investments. Statistical methods help investment professionals summarize financial data, identify patterns, estimate relationships, and assess uncertainty in investment outcomes. Because alternative investments often exhibit non-normal return distributions, illiquidity, and valuation complexity, statistical analysis becomes especially important for understanding portfolio risks and expected returns. The program focuses on descriptive statistics, probability distributions, covariance, correlation, regression analysis, and hypothesis testing. These concepts provide the analytical framework necessary for quantitative investment management, performance evaluation, and informed decision-making in increasingly sophisticated global financial markets. A major topic is the summarization of investment data through descriptive statistics. The program explains measures of central tendencies such as mean, median, and mode, which help describe the typical behavior of investment returns. Measures of dispersion, including variance and standard deviation, quantify the degree of return volatility and investment risk. Higher standard deviation indicates greater uncertainty and wider fluctuations in returns over time. The program also introduces moments of a distribution, including skewness and kurtosis, which describe asymmetry and the probability of extreme outcomes. Alternative investments frequently display non-normal distributions with significant skewness and fat tails, making these measures essential for understanding risks that traditional models may underestimate. The program further examines covariance and correlation, which measure relationships between asset returns within a portfolio. Covariance indicates whether two investments tend to move together or in opposite directions, while correlation standardizes this relationship on a scale from -1 to +1. Diversification benefits arise when investments have low or negative correlations because combined portfolio volatility may decline even if individual assets remain risky. The program emphasizes that many alternative investments exhibit relatively low correlations with traditional equities and bonds, making them attractive for portfolio diversification. However, correlations may change during periods of financial stress, reducing diversification benefits precisely when investors need them most. Understanding correlation dynamics is therefore critical for effective portfolio construction and risk management. Topic also introduces beta, autocorrelation, and regression analysis as tools for evaluating systematic risk and investment relationships. Beta measures an investment's sensitivity to movements in a benchmark or market index and helps assess systematic risk exposure. Regression analysis estimates relationships between variables and identifies how changes in one variable influence another. The program explains that alternative investments may exhibit autocorrelation because of illiquidity, appraisal smoothing, or delayed pricing adjustments. Autocorrelation can artificially reduce observed volatility and distort performance measures, leading investors to underestimate risk. Professionals must therefore evaluate statistical relationships carefully and understand the limitations of reported data when analyzing alternative investment performance and portfolio behavior. The program additionally addresses tests of normality and the importance of recognizing non-normal return distributions in alternative investments. Traditional financial models often assume that returns follow a normal distribution, but many alternative investments display asymmetric returns, fat tails, and extreme events more frequently than predicted by normal models. Statistical tests help determine whether observed return patterns differ significantly from normality assumptions. Recognizing non-normal distributions is important because standard deviation alone may fail to capture downside risk adequately. The program highlights that investors should consider additional risk measures, stress testing, and scenario analysis when evaluating investments with complex return characteristics. Understanding statistical limitations improves risk assessment and supports more informed investment decision-making. Finally, topic emphasizes the broader role of statistical analysis in alternative investment management and portfolio construction. Statistical tools support risk measurement, diversification analysis, performance evaluation, and strategic asset allocation decisions. Investment professionals must interpret statistical outputs carefully while recognizing the influence of illiquidity, leverage, valuation uncertainty, and market inefficiencies on observed data. The program reinforces that statistical analysis should complement sound economic reasoning and qualitative judgment rather than replace them entirely. As alternative investments continue to expand within institutional portfolios, sophisticated statistical methods become increasingly important for understanding portfolio behavior and managing financial risk effectively. Strong statistical foundations enable professionals to evaluate investments more rigorously and navigate complex financial environments with greater confidence and analytical precision.